Hello everyone. In this recording we are going to take a look at some of the homework for Chapter 11 where we are making decisions based on data given. Alright, so we have two questions here for the first exercise. We have number one, a company has an inventory of 1,200 assorted parts for a line of missiles that have been discontinued. The inventory cost is $71,000. So here are our two alternatives. The parts can either be remachined at a total additional cost of $24,000, and if we do that, we will then be able to sell them for $34,000, or we can sell them for scrap for $5,000. Which action is more profitable? So what we're going to do here, this is a decision-making process where we are going to analyze our two alternatives. And the key that we learned in this chapter was we will look at the relevant revenues and the relevant costs. The relevant revenues and the relevant costs are the revenues and costs that are different between the two alternatives. So alternative A, where we remachine, we'd be able to get future revenue of $34,000. But if we simply scrap it, which is alternative B, we'd be able to get future revenue of $5,000. Those two are different amounts, so they are relevant. But the remachining, alternative A, we have to spend $24,500 in order to do so. If we just scrap it, we have no future costs. So the future revenues deduct future costs gives us operating income. So if we remachine, we should be able to get a net of $9,500 operating income versus $5,000 if we simply scrap. So ignoring all qualitative measures, and we're just looking at quantitative measures, we are simply going to choose column A. But of course, qualitative measures need to be considered here as well. Let's look at part B, which is very similar in regard to comparing relevant revenues versus relevant costs between our two alternatives. So with number two, we have a truck. It costs $101,500 and it's uninsured. It's wrecked on the first day of use. So we drive off the lot of the car lot, and of course, boom, we get into an accident as soon as we drive off. Completely uninsured. So we just spent this $101,500 and it's gone. So what are our alternatives? A, we can dispose of it for $14,500. So wow. This truck, which just cost us $101,500, we can sell it literally same day, first day in use, for only $14,500. And if we do, we can replace it with a similar truck costing $102,500. Or alternative B, we can rebuild this for $89,000 and basically get it back to brand new status. So alternative A, we can buy a new truck of $102,500. But we'll be able to get $14,500 sales revenue for the beat-up truck. So the net amount, $88,000, is our net costs. If we rebuild, as we said, the net cost was $89,000. So just looking at this quantitatively, it looks like we should replace the truck. Sell the old truck that's already beat up and buy a new truck. Save a little bit of money. But once again, this is looking at it quantitatively, where we are looking at the relevant revenues and the relevant costs, which once again, relevance means the difference between alternatives. If a certain revenue or cost is the same among the two alternatives, they would be ignored. Now, something else was thrown in here in number two that I want to mention. With number two, it said the truck costs $101,500 and it's wrecked on the first day in use. This is a past cost, or something we call a sunk cost. We're not getting that $101,500 back. I would dare you to try to turn around to the car dealer and say, hey, I changed my mind. Here's your truck back. Give me my money back. It's not going to work. It's a sunk cost, and sunk costs are always irrelevant. We can't use them as a decision-making tool. It's simply gone. We have to forget about the $101,500 and we have to look forward. What are the future revenues and future costs? amongst our alternatives. In this next problem, we have two scenarios. And this is make or buy, or keep versus replace. Let's take a look at part one, where we are deciding whether we should make the part ourselves in our own manufacturing plant, or if we should take up somebody's offer and buy it outright. So number one, it seems like we have a company. They make 5,200 units of a certain circuit board called CB76, which is irrelevant, the name of it anyway. And we make them, and our internal cost is $270 each. Now that $270 each is broken down between variable cost of $190 and fixed cost of $80. So we're making it internally for $270. Now we have another company called Peach Electronics. They said, hey, you know what? We'll do this for you, and we'll do it for you for $250. So the company is saying to themselves, hey, we do this internally for $270. Someone is coming along and says, hey, we'll manufacture it for you for a price of $250. Well, if you don't do any further analysis, it's a very easy decision. You say to yourself, hey, if they're going to sell this to us for $250 and I'm spending $270 to make it, I might as well buy it from somebody else. But my answer to you is not so fast. You're not analyzing this properly. Remember, the whole idea of the analysis is to analyze the relevant costs and the relevant revenue. In this case, we're talking about costs. So if this company buys from Peach, the other company, it will be able to save $20 per unit in fixed costs. But it will continue to incur the other $60 per unit in fixed costs. So should we accept the offer? So what we do in a situation like this is we have our two alternatives, two columns. The first is we make it internally, and the second column is we buy it outright. And we're going to look at the relevant costs. Remember, a relevant cost is a cost that is different between the two alternatives. Well, if I make it internally, I have to spend the variable cost of $190 per unit. I wouldn't have that if I bought it outright. So we have $190 in one column. The other column I have 0. Now, how about if I make it internally? Do you remember it said up here, if we buy it from Peach, we'll be able to save $20 per unit in fixed costs. So the only difference, instead of putting all the fixed costs under the make column, I'm only putting the 20. Because the 20 is going to be the difference between the two. The 60 is going to be the same. Regardless, if I make it internally or if I buy it outright, I still have to pay the $60 fixed cost per unit. So the difference is only the 20. All right. Remember, we're only looking at not all costs, but relevant costs. And of course, in the buy column, the purchase price, if we buy it outright, is $250. So now what's your decision? Wow, which one is going to give us smaller relevant costs? Making it internally. So this just goes to show you, don't make a quick snap decision saying, oh, it cost us $270 to make and $250 to buy, we might as well buy it outright. Remember, out of the $270, $60 is going to be spent regardless if I make or buy. So only $210, not the $270, is going to be used in our decision-making process. Only the relevant costs. All right. Another thing we could have done, if you wanted to really look at it in total, you could have put 80. You could have put the full 80 here under make, and under buy you would have put 60. Doesn't matter, right? Making it's going to cost more than buying it in regard to the fixed costs. All right, and the second example here, we have, what do we have? We have a company. They're deciding whether to keep their old machine or replacing their new machine. Okay, so here's the information given to us over here in the right-hand side. We can see our old machine cost us $10,600, but if we buy the new machine, we can buy it for $9,600. The original useful lives, the current age, the remaining useful life is 3 years on each, And on the old machine, we have accumulated depreciation and book value, the current disposal value, how much what's the value if we disposed of it right now. And of course, we have our annual operating costs. The reason why we're thinking of this is because the old machine, it cost us $16,000 to maintain every year and operate. But the new machine, you can see it is more efficient. We only have to spend $13,000 a year on cash operating costs. So once again, we're going to do our two-column approach. What are going to be the relevant costs to keep versus replace? Well, to keep it, I just need to know that I have $16,000 in operating costs for 3 more years. 16 times 3, that gives us our $48,000. And that's all we need to worry about. We're not going to consider depreciation. We're not going to consider the original cost of buying the machine. Those are sunk costs. We can't change that. That original cost is going to be in place. We can't change the fact that we bought it. It's done. It's a sunk cost. And depreciation, we're going to have depreciation because it's associated with that original equipment. Versus replace it. If I replace it, my cash operating cost is only $13,000 a year times 3 more years, or $39,000. But remember, if we replace it, what are we going to be able to do? We'll be able to sell our old machine for $2,200. So $39,000 cost minus the $2,200 we'd get from selling the old machine, and then we got to buy the new machine for $9,600. These are relevant costs because these are future costs that we would need to incur. And when you consider what are the relevant costs to keep, $48,000 versus replace, $46,400, it is in favor of replacing. These would be less costs. Okay, in this next problem, we have 2 parts. And the bottom line is the same with all of these questions. We are analyzing the relevant revenues and costs. So number 1, we have a company called the Jersey Company. They manufacture slippers and they sell them for $9 a pair. Variable manufacturing cost is $5 a pair, and allocated fixed cost is 75 cents a pair. It has enough idle capacity available to accept a one-time special order. So there is a potential customer. They want to make a one-time only special order. They want to buy 35,000 pairs of slippers, which we can fit into our assembly line process. We have enough idle capacity where we can fit it in without affecting other customers. That's very important. But they only want to pay, instead of $9 a pair, which is our normal sales price, they only want to pay $5.75 a pair. And Jersey will not incur any other marketing costs or anything as a result of the special order. So what will happen to net operating income if we accept this special price of $5.75? Well, the key here with special orders, what you want to zone in on is how it affects contribution margin. If contribution margin can be increased, that means the operating income should also be increased as well. Remember the formula. We have our sales less our variable cost gives us contribution margin. Contribution margin minus fixed cost give you operating income. Well, if fixed cost doesn't change, and they usually don't because they stay the same regardless of activity, whatever happens to contribution margin should also happen to operating income. So if we accept a special price, sales price of $5.75, we'll subtract our variable cost per unit, which we said was 5. So we are making additional contribution margin. Not a lot, but a little bit, 75 cents. Multiply it by the special order of 35,000, and you will get 26,250, which is the effect on the operating income. Now part 2, we have a decision whether we should make it ourselves or buy it outright. We have a company called Savannah Company. They manufacture a certain part, number 498, for use in the production line. The manufacturing cost per unit for 10,000 units is as follows, and we can see the details over here in the far right data table. To make a unit, $11 direct materials, $29 variable direct labor, $16 variable overhead, and $19 fixed overhead. That's allocated $19 per unit for a total manufacturing cost of $75. Now, the seat company, which is another company, they have offered, instead of us, the Savannah company, manufacturing the part, the seat company has offered to make the part for us for $71 per unit. Savannah will make the decision to buy the part from seat if there's an overall savings of at least $35,000. Okay, so also, if Savannah accepts seat's offer, $5 of the fixed overhead, so $5 of this $19 would be eliminated. All right, so let's take a look. If we purchase outright from seat company, that would be 10,000 units times $71 or $710,000. Okay. Now, how about the relevant costs? Now, once again, we're not talking about all of our costs. We're talking about the relevant cost of making it. Remember, the relevant costs are those costs that are different between making it or buying it outright. So all the manufacturing costs, which are all the variable costs, which is the direct materials, the direct labor. So direct materials of 11, direct labor of 29, and your variable overhead of 16, if you add them up, comes to $56. That is relevant because we would have to spend it, all right, if we would have to spend it if we made it ourselves, but we would not have to spend it if we bought it outright. Now, how about the fixed cost? Normally, the fixed cost would be irrelevant, all right, unless there is a difference between the two alternatives. And down here, we said if we accept the seat's offer, $5 of the fixed overhead would be eliminated. So only $5 out of the 19 would actually be different between alternative 1 and 2. So adding it up, we would actually, the cost saved by not making or by buying outright, we'd save $61 per unit times 10,000 units. 61 times 10,000, we'd save $610,000. All right, if we didn't make it ourselves. So the cost to purchase outright minus making ourselves, there's $100,000. $100,000 of extra cost if we purchased outside. If the minimum savings required it needs to be $35,000, as we said earlier, the necessary relevant cost to be saved would be the sum of the two, or $135,000. In this next problem, we're going to take a look at a company, Lawnux. They manufacture lawnmowers. It predicts it will purchase 204,000 spark plugs next year. So this company, Lawnux, they estimate that 17,000 spark plugs will be required each month. A supplier quotes a price of $7 per spark plug. The supplier also offers a special discount option. If instead of buying the 17,000 spark plugs monthly, if we buy all 204,000 spark plugs at the beginning of the year, we'd get a discount of 4% off the $7 price. In addition, we can invest our money and make 10% per year. All right, so you're starting to see what we have to analyze here. Should we purchase all 204,000 spark plugs at the beginning of the year? Or should we purchase 17,000 spark plugs each month? We also will consider the investment gains that we could make on the money. Remember, we can make 10% on our idle cash. That needs to be considered. Okay, so here is how we're going to calculate it. So if we buy 204,000 units at the start of the year, 204,000, remember we're not going to spend $7 per spark plug, the author said we'd get a 4% discount. So, or we'd have to pay 96% of the $7, whichever way you want to look at it. 96% of the $7 is this $6.72. So if you take 204,000 divided by 672, and we're going to divide by 2. The reason why we divide by 2 is, once again, this is an average. So at the beginning of the year, we have all of the spark plugs on January 1st. By the time December 31st rolls around, a full year, we should have used all the spark plugs. So you're going to take a simple average. All the spark plugs are there at the beginning of the year. None of them are left at the end of the year, so we will simply divide by 2. So the average investment in inventory at any given time is this $685,440. That's the average investment that we have. Our cash is basically tied up in that inventory. Versus if we buy 17,000 spark plugs a month, 17,000 times the full $7, we don't get any discount. And once again, as I said earlier, we'll divide by 2. So the average investment at any given time in the inventory is only $59,500. The difference between the $685,440 and the $59,500, that is the difference in the average investment, which is $625,940. Now, that difference in investment, if I had it in cash instead of having it tied up in inventory all year long, I'd be able to take that difference in the average investment and I'd be able to invest it, which we said earlier, if I'm able to invest, I'd be able to earn 10% on my money. The $625,940 times 10% equals $62,594. That is called the opportunity cost. Remember, once again, the opportunity cost is the benefit given up by choosing one alternative over another. So I am giving up $62,594 of potential investment earnings if I decide to buy the 204,000 units at the start of the year versus every month. Opportunity costs are not recorded in the accounting system. There's no journal entry for the opportunity cost, but this is something that is very important to the decision-making process. We can't lose sight of what we could do with the money if we choose one alternative versus the other. So in the next requirement, what we're going to do is we are going to show the calculations between the two alternatives in total. In the first one, we just looked at the opportunity cost for the idle cash, but here, if we buy all 204,000 at the beginning of the year versus we're buying 17,000 spark plugs at the beginning of each month. Okay, and the author is saying here that, I should have read this up here, and let me highlight it so you see it. I'm up here. It costs Lonnex $250 to place each order. So if I only place one order for the whole year and I buy all 204,000 at the beginning of the year, my one purchase order price is $250 plus the annual purchase costs. And what are the annual purchase costs? Well, let's take a look at it. We have $6.72, which is the dollar amount per spark plug if we bought all 204,000 up front. So if we take 672 times 204,000, we'll get 1,370,880. All right. Now, if we purchase 17,000 spark plugs a month, we'd have to make 12 orders a year, right? One a month. So if we take 250 times 12, my purchase order costs are $3,000. And what about my costs to actually purchase the items? Well, we're purchasing the items at the full $7 each. So over the course of 12 months, $7 times 204,000 or $1,428,000. Wow, it's looking like purchasing 17,000 each month. It looks like it's much more expensive. And if you stopped right there and said, hey, it's a lot cheaper if I just buy them all up front, you would be wrong. Because what are you ignoring? you are ignoring the opportunity cost that we talked about earlier. And once again, the opportunity cost is the benefit given up. So what is the benefit given up? If we tied up all of our money in the beginning of the year, we talked about it earlier. Do you remember the opportunity cost was $685,440? All right, times 10% or $68,544 is the benefit given up if we choose this alternative. That needs to be considered in the calculation. And how about if we only tied up an average of $59,500 a month because we're buying slowly every month? Well, the opportunity cost is a lot smaller. Remember the difference between the two, $62,594? We calculated that up here in number 1. All right, so that doesn't go away. But this is what I'm showing you. Even though the opportunity costs are not recorded in the journal entries anywhere, we need to consider it when we are choosing amongst our alternatives. In this case, the benefit given up is going to be added to the cost. So you can see by choosing alternative A, buying the spark plugs all up front, the relevant costs are higher than if we bought monthly. So buying monthly looks like it's cheaper overall when you consider the opportunity costs. In this next problem, we are dealing with a constraint. And a constraint is something that we are limited. And in this case, we have a takeout food store and a popular beach resort. In this example, the takeout food store is called the Wave Crave. So Susan Miller, who owns the Wave Crave, they're deciding how much refrigerator space they should devote to 4 different drinks. So we only have so much space in the refrigerator. We don't have unlimited refrigerator space. Therefore, if we have competing drinks, and in this case we have 4 competing drinks, all right, we need to decide out of those 4 drinks, how much space in the refrigerator should it take? All right, remember, the refrigerator space is our constraint. Okay, Miller has a maximum. I'm over here. Miller has a maximum shelf space of 12 feet to devote to the 4 drinks. So we need to take this 12 feet of space and decide how much for each drink. How many feet do they get? Now, we can't say 12 feet for one and 0 feet for the rest. She has an internal rule, right? Because she has customer demand for all 4. So she has to carry all 4. But at a minimum, she wants 1 foot for a drink, and at a maximum, she wants 6 foot for a drink. So we need to choose between 1 and 6, or somewhere in between. So what we're going to do, so we need to decide how much square feet, or I should say how much feet in shelf space in the refrigerator should we give? Well, we have 4 drinks. And you can see over here the author is telling us we have cola, we have lemonade, we have punch, and we have natural orange juice. So the author tells us the selling price for cola is $18.50, but the variable cost per case is $13.80, so our contribution margin per case is $4.70. Lemonade is $4.25, the punch $7.40, and the natural orange juice $9.10. Without considering anything else, if you took a look at the contribution margins per case, you would say, naturally, I would choose the natural orange juice to devote most of the space to. They are making $9.10 per case. All right, so a coworker of Miller, they recommend that let's give orange juice the most space. They have the highest contribution margin per case. So the first question is, do we agree with this? And the answer is no. The reason why we disagree with this is because when you have a constraint, and this is what we do in cost accounting, when there is a constraint, you need to figure out not the contribution margin per, in this case, per case. We need to figure out the contribution margin per constraint. And the constraint is the number of feet on the shelf in the refrigerator. Okay, so that's where this comes in. If we take a look over here in the upper right, the cases sold per foot of shelf space per day. So now we're getting down to where we need to be. All right, we are actually figuring out the cases sold per foot of shelf space. That's the constraint, the shelf space. So, cola, if we had contribution margin of $4.70 per case times the number of cases sold that we just were given to us in our original problem, 470 times 6 is 28.20. Lemonade, $4.25, and we sell 24 cases a day. So that means $102 is your contribution margin per foot of shelf space. The punch, $7.40 is the contribution margin per case, and we're selling 25 cases per foot. That's $185. And the natural orange juice, $9.10, which we calculated earlier, and 23. All right, so 209. So out of the four, which one gives you the most contribution margin per foot of shelf space? Yep, the answer is still orange juice. But remember, we couldn't have jumped to that. We have to break down our contribution margin per constraint. In this case, it's the shelf space. So what we want to do is we would like to give orange juice the biggest amount of shelf space, which is the maximum of 6 feet. So if we give 6 feet to orange juice, all right, and it's $209.30 per foot of shelf space. 6 times 209, the contribution margin per day by selling orange juice would be 6 times 209, or $1,255.80. Now what's next? The next is punch by a large margin. So we want to give punch, we would love to give punch the remaining 6, but we can't. Remember, we have to give the bottom two, cola and lemonade, we have to give them at least 1 foot of shelf space. So 1 times 28.20 equals 28.20. Lemonade, 1 times 102 gives us 102. And then if we have 12 feet and we've already allocated 8, we got 4 left, and we'll give them to the punch. 4 times the 185, that'll give us 740. So if we maximize our contribution margin with our constraint, which means the shelf space, we'd be able to get contribution margin per day of $2,126. In this next homework problem, we have a constraint, and the constraint is the machine hours in our assembly plant. So we have a company here called Fitness Gym Inc. They actually manufacture 2 basic types of weightlifting equipment. One is called the Model 9, and the other is called the Model 14. So in our manufacturing plant, we can sell enough of either 9 or 14, Model 9 or Model 14, and it'll keep the plant operating at full capacity. So that's a good thing. We can sell both. We can stay at full capacity. Here's the information. Over here in the far right, the data table given to us. If we sell Model 9, $145, here are all of our costs, both variable and fixed, to give us operating income of $47 per item. Model 14, the selling price is a lot lower, 100, and guess what? So is the operating income. It's a lot lower. Okay, so looking at this, just this bottom line, if I'm getting $47 operating income to sell one Model 9, $31 contribution margin or operating income, to make one Model 14, all other things being equal, you say, heck, I want to make a Model 9, make as much as I can, but slow down. Remember, we have to decide what is going to give us the highest contribution margin per our constraint. And the constraint is the number of hours on the assembly line machine. Now I want you to zone in on this here. It says fixed overhead. Fixed overhead, you can see the little asterisk here. $6 was allocated to Model 9. Model 14, $3 was allocated to Model 14. And the little asterisk down here on the bottom, the little asterisk says The allocation is based on machine hours. You know what this tells me? It takes twice as long to make a Model 9 as a Model 14, doesn't it? Think about that logically. If I allocated double to Model 9 than 14, it takes double the amount of time. So for every 2 hours to make a Model 9, only 1 hour to make a Model 14. All right? So when we come back here to our calculation, we're going to take our selling price for both, which the author gave us, and we're going to consider our not total costs, remember, variable costs per unit. All right? And so what are the variable costs for Model 9? It's the direct materials of 29, the labor of 17, manufacturing overhead of 26, and the marketing we said was all variable. So you're ignoring this overhead allocation. That's where it gets to 92. You do the same thing with Model 14. The 11, the 29, the 13, and the 13. You add them up, that's $66. That gives you your contribution margin per unit. But remember, if it takes twice as long to make a Model 9, which we inferred from over here, it takes twice as long to make a Model 9 than a Model 14, the Model 9 contribution margin per unit will divide by 2 to give us our contribution margin per hour. But the Model 14, right, we're only dividing by 1. It takes half the amount of time to make a 14 than a Model 9. So which one actually adds to our bottom line more? We're no longer saying the Model 9, which we did earlier when we did not consider the constraint, which is or in this case, the number of hours on the machine. Model 14 will give us the higher contribution margin per machine hour, which is what we want. In this next problem, we have a company, Rivera Corporation. They have 2 convenience stores, one in Connecticut, one in Rhode Island. And over here in the far right-hand column, we're taking a look at the data. For the Connecticut store, it looks like revenues less the operating costs, positive $61,000 in operating income. The Rhode Island store, revenues of $840, less operating costs, to get you to an operating income that's negative $85. So at first glance, you're thinking to yourself, we should close the Rhode Island store. We are losing money. We're losing $85,000 a year. Should we go ahead and do so? And you have to think more than just looking at the data, because some of these costs may not be relevant to the decision remaining. Remember, we have to only analyze the relevant revenues and costs. I can't say that enough. So if we closed, and this is what we're doing here on the left-hand side, if we closed the Rhode Island store, would we lose revenues of $840? We would. So lost revenues, we're going to say negative $840. Would we lose the cost of goods sold of $690? We would. So that's going to be a positive, right? Losing an expense is a positive. How about the lease rent? $78,000. Yeah, we'd lose the rent, right? It's its own separate store. It's not like it's sharing the rent with the Connecticut store, so that goes away. How about the labor costs? $40,000. Yeah, that goes away. How about the depreciation on the equipment of $20,000? The depreciation is going to continue, whether we close the store or not. Remember, the depreciation is associated with a piece of equipment that we purchased earlier. That is a sunk cost, so it's irrelevant to the decision. How about utilities of $54,000? Would we lose that cost? Yeah, we would. So that is a positive for the decision. And how about the allocated corporate overhead of $43,000? Well, you have to be careful here. Sometimes the corporate overhead is not we don't eliminate it at all. If that was the case, it would be non-relevant. But in this case, the requirement states, and I should have read this to you earlier, I'm kind of highlighting it up above. It says, if we close the Rhode Island store, we'd be able to reduce corporate overhead by how much? by $49,000, more than the $43,000 it's allocated. So $49,000 is the lost expense. So we would lose $840,000 in revenues, but we would lose $911,000 in expenses. All right. So if we close the store, we would actually gain $71,000 to our operating income. So yes, even though our initial gut reaction was to close the Rhode Island store, we proved it and said, yeah, the effect is not a full 85. That's what we were originally thinking, that we'd gain $85,000 in operating income if we sold the store. Well, not the full 85. It's actually 71. So yeah, go ahead, close the store. You gain operating income of 71,000. Now the second part of this says, now Rivera, let's say we keep the store open. So instead of closing the Rhode Island store, we're going to keep it open. And in addition to keeping it open, we're going to open another store with revenues and costs that are identical to the Rhode Island store, including a $20,000 cost to acquire a piece of equipment. It's got a 1-year useful life, 0 disposable value, so full expense in year 1. Opening the store will increase corporate overhead costs by $6,000. So we'd gain $840,000 in revenues, just like the Rhode Island store would. We'd have the same cost of goods sold of $690, same rent of $78, same labor cost of $40. We'd have the depreciation on the equipment of $20. Remember, one-time cost, $20,000. It's got a 1-year life. We'd have utilities of $54. And instead of overhead of $43, we stated up here that we would actually increase overhead by $6,000. So we'll take the $6,000. So if we opened another store, it would actually have a negative $48,000 effect on net income. So we probably shouldn't open that third store. We probably should just keep going with the Connecticut store, close down the Rhode Island store, or find another place where it's more profitable. In this next problem, we have an opportunity to accept a special order or not. So we have a company here, Hitter Corporation. They produce baseball bats for kids, and they sell them for $31 each. At capacity, the company can produce 54,000 bats a year. So their existing assembly line can only handle 54,000 bats a year for manufacturing. The costs are as follows, and we can see over here in the right-hand table, the direct materials per bat, 11, direct labor, 4, variable overhead, 1, variable selling, 2, and then our fixed cost. Our fixed overhead is 3 per unit, and our fixed selling costs are 3 per unit. So let's say requirement 1. Let's suppose the company, Hitter, is currently producing and selling 26,000 bats. Now remember, we have room to make 54,000 bats a year. We're only making 26. Currently producing and selling 26,000. At this level of production and sales, the fixed costs are the same per unit. All right, the fixed costs in total, are the same. Per unit, obviously, they change, but this is the level where they are the same. We're in the same relevant range. Now, remember, we're making 26,000 bats. We have room to make 54, so we have excess capacity. We have idle capacity, I should say, to make an additional 28,000 bats. And say there's a company called Aaron Corporation. They want to place a one-time special order for the 28,000 bats. As I just explained to you, we do have enough capacity within the assembly line in the manufacturing plant to make these 28,000 bats. But they don't want to spend $31 to buy each bat, which is our normal sales price. They only want to spend $23 each. Hitter will incur no variable cost for the special order. Should we expect the special order? Well, once again, we're going to analyze the relevant revenues and the relevant costs. So the relevant revenues, if we don't accept the special order, we have additional revenues of 0. But if we do accept the special order, we're going to get the special sales price of $23 times 28,000 bats, a total of $644,000 is your relevant revenue. Now how about relevant costs, the manufacturing costs? Well, 11 plus 4 plus 1, that's 16. We said the fixed costs are not going to change regardless if we accept or not. We're going to have to spend those fixed costs, so that's not relevant. And we said we wouldn't incur additional selling expenses, so the $2 variable expense per unit is also irrelevant. So if we add the 11, the 4, and the 1, those are the three relevant costs, which are 16 times 28,000. So the relevant costs in this case are 448. The difference is 196,000 positive. So I would say accept the special deal. If we have all this idle capacity, we can at least accept a special order, which would give us additional contribution margin, additional operating income. Now the second requirement throws a little bit of a wrench into it. Requirement 2 says, well, wait a minute. Let's say, number 2, now suppose Hitter is currently producing and selling 54,000 bats. So we have no extra room. We are at full capacity. Remember, we said the company can only produce 54,000 bats a year. So if we accept the offer to sell the 28,000 bats, guess what? We're going to sell 28,000 fewer bats to our regular customers. Would we even consider this? If we are making $31 a bat to our regular customers versus $23 to our special order customer, Aaron. Not sure that this passes the smell test. So let's again look at our analyses. And once again, we're looking at quantitative analysis. So if we expect the special order, as we said earlier, we get an additional $644,000. If we accept the special order, we'd have additional variable costs of $448. But here's the new item. If we accept the special order, we have to get rid of, right? We lose contribution margin on the regular customers. And let's figure out that 364. Okay. What is the contribution margin on our regular customers? Well, selling price, I'm down here circling. Hopefully you see me. All right. The regular sales price is 31. And our variable expenses are 11 for the materials, 4 for the labor, 1 for the variable overhead, and 2 for the selling expenses. If you do the math, our contribution margin per bat in our regular customers is $13. If you take $13 and we lose the ability to sell 28,000 bats to our regular customers, we would lose $364,000 in contribution margin. So when we had idle capacity, yeah, it made sense to accept the special order of 196. It adds 196,000 to our operating income. But when we have to eat into our regular customer base and we lose some contribution margin, guess what? It actually decreases overall operating income to accept the special order. So this is a very important homework problem which explains to you it all depends on capacity. If we have full capacity to accept the special order, it's pretty simple. If it adds to the contribution margin, go for it. But if we are at full capacity or we're at capacity where we can't fully accept the special order without affecting our normal customers, we have to also calculate what kind of contribution margin are we giving up by accepting the special order. Okay, this next problem, we have a company, the Burke Company. They produce gas grills. This year, their expected production is 30,000 units. Now, each grill comes with side burners. All right, and each grill comes, I should specify, each grill comes with 2 side burners. So you have the grill, and then you have 2 side burners. So Burke's cost account or a management account reports the following costs. You can see it over here on the right-hand side for making the 60,000 burners. Remember, 30,000 grills times 2 side burners each gives you 60,000 burners. So the cost for 60,000 side burners, the direct materials, $6.25 each times 60,000, or 375,000. Variable labor, $2.70 times 60,000, or 162,000. The variable overhead is $1 times 60,000 equals 60,000. The inspection is a flat $5,400. These are fixed costs. Machine rent, $5,000, flat fixed cost, and allocating the administrative fixed cost, $70,000. So $677,400 are our total cost to make the 30,000 gas grills and 60,000 side burners. Now, Burke received an offer from an outside vendor to supply the side burners for $9 per burner. And so the company, Burke, needs to decide, should I buy them outright or should I make them myself? So what we're going to do, we can see to buy them outright, $540,000. That's the $9 times the 60,000 burners. All right, that's your $540,000. Now, how about making them ourselves? All right, as we said, we have the information for making the burners here. We're not going to take the full 677. We only need to pull in the costs that are relevant, meaning the costs that are different between choice 1 and choice 2. And that would basically be everything except for the allocated fixed costs. The direct materials, the variable overhead, the variable labor, the inspection, the setup, the materials handling. Yes, it's a fixed cost, but it goes away if we don't have to do that. The machine rent, the rent of the machine goes away if we don't have to worry about using the machine. All right, so everything here is relevant except for the 70. So 607,400 versus 540, which is the lowest? Buying it outright. So on this analysis alone, we should go and we should accept the vendor's offer to actually manufacture the side burners for us. Okay, so very, very important. Make sure you understand how to do that. And this is a little bit tricky because it says that some of the fixed costs are actually relevant. Usually the fixed costs are irrelevant, but in this case, some of the fixed costs were relevant because they actually do disappear if we go ahead and we buy them outright versus continuing to make them ourselves. Okay, the second requirement, a little bit different. For the second requirement, instead of the attached burners, remember 60,000 attached burners to the 30,000 grills, the facilities where the burners are currently made will be used to upgrade the grills by adding a rotisserie attachment. All right, so each grill gets a rotisserie attachment. All right, each grill contains 2 burners and 1 rotisserie attachment. So as a consequence, the selling price of the grills are actually going to be raised to $28. Raised by, $28. So an additional $28 if we have this rotisserie attachment. And we'd have additional variable costs of $22, all right, if we have this rotisserie attachment. And we'd also have additional tooling costs of $120,000 that would be incurred. So once again, the question is, on quantitative analysis alone, no qualitative analysis, should Burke make or buy the burners? So remember, we're dealing with 60,000 burners, assuming that 30,000 grills are produced and sold. So you remember these costs. If we make them internally, the burners, we got that from part 1, the $607,400. But the buy decision is not only the $540,000 to purchase it outright, we also have to consider the additional tooling costs, which we said was $120,000. Okay, that is a cost that we would have. if we buy it outright. And the upgrade, remember, the upgrade gives us an additional 28 minus 22. It gives us an additional $6 contribution margin times 30,000 units. All right, 6 times 30,000 is 180,000. All right, so buying elsewhere, yeah, we would still have smaller relevant costs than making it internally. So once again, it makes sense to buy the burners outright. We can go ahead and we can use that extra capacity in our warehouse, is basically what we're discussing here, to do the rotisserie attachments. And if we do that, yes, we'd have additional tooling costs, but we would also have some extra revenues. So certainly buying outright, we're going to decrease our relevant cost by bringing in the extra revenue, and of course the extra tooling costs. So once again, it makes even more sense to buy it outright than making it internally. All right, we can have better use of our time if we buy the burners outright, and we can use all that idle capacity to make the extra rotisserie attachment. Okay. And last but not least, requirement 3, the sales manager at Burke, they're really concerned. They're estimating, they're saying, you know what, selling 30,000 grills seems to be a bit high. They believe only 24,000 grills will be sold. And so the accountants, they actually accept this sales manager's advice or concern, I should say. And they say, you know what, let's run the numbers with 24,000 grills sold only instead of 30,000. We'll cut back production. We can free up workspace. And the space could be used to add the rotisserie attachments that we talked about. And so if this is the case at the lower output of 24,000 instead of 30,000, we can produce the burners in 48 batches of 1,000 units each. Remember, 24,000 grills, that equals 48,000 burners. So, once again, the question is, quantitative only, should we purchase the burners from the outside vendor? And the answer is yes, so let's go through the details. So, the direct materials, remember, this was from earlier, we were given this information to us, $625 per unit times 48,000 units, so 300,000 materials, 129,000 is the labor, 48,000 is the overhead, 4,320 is the inspection, and then 5,000 is the machine rent. All right, so those are certainly the I guess the reduced cost to make it internally versus buying outright. We said the purchase price is $9 per burner. 9 times 48,000, you get your 432. So even still, across the board, it makes sense to buy the burners outright. And we can use excess capacity to make rotisserie attachments. Okay, in this homework problem, we are dealing once again with a special order. So we have a company, they're a landscaping company. All its landscaping work requires the company to use landscaping equipment. And the equipment has the capacity to do 14,500 hours of landscaping work. It's currently anticipating getting orders that would utilize 13,800 hours of equipment time from existing customers. The company charges $100 per hour. So we have an opportunity to take a special order, and I'm reading down here in the bottom right requirement. We have an opportunity to work with a special order customer, Nancy Corporation, but they don't want to pay $100 an hour. They only want to pay $50 an hour, and it would require 2,800 hours of equipment time. And if we accept this offer, the total variable landscaping costs are $70 per hour, and the variable marketing costs would be 7% of revenues. So let's discuss whether we should accept the offer or not. Now, the only reason we're thinking about the offer is because we have some idle time. you can see our regular customers, what did we say earlier? We utilize 13,800 hours of equipment time, but we have the capacity to use 14,500 hours of equipment time, landscaping time. Okay, so this is the data table with the regular customers making $100 an hour times 13,800 hours, or $1,380,000. Our relevant costs, which are only the variable costs unless told otherwise. We have 966,000 landscaping costs, and we have 96,600 in marketing costs. Okay, and so we list them here. And so the relevant costs are $1,062,000. Subtracted from the relevant revenue, you get relevant operating income. Now if we accepted the special order, remember the special order was 2,800 hours from Nancy, but they only want $50. They only want to pay $50 an hour. So what would be my relevant revenues if I did accept the special order? Well, it comes to $1,310,000. How do we get that? Well, the first 2,800 hours for the special order times $50 an hour, 2,800 times 50, that gets you to $140,000. And then what we'll do is we'll add to that our total capacity, which is 14,500 hours, minus the 2,800 hours devoted to the special order. That gives us a certain amount of hours. So let's take 14,500 minus 2,800. That gives us 11,700 hours that we can bill to regular customers times $100 an hour. That is $1,170,000. If we add that to the $140,000 we're getting from the special client, the one-time client, you get $1,310,000. And then we'll subtract out our landscaping cost, which is $70 per hour. So 70 times 14,500 will get you the $1,015,000. Marketing cost is 7% of the revenues. So 7% of the $1,310,000 will get you $91,700. Anyway, you work down. If we accept the special order, the relevant operating income actually decreases. So we should reject the special order.